In the last decade, we have seen how the US and eurozone have kept the interest rate at near zero level and flooded the system with liquidity to boost the economic growth. But the growth didn't bounce back in the last decade, and inflation also remained below the targeted level of the central banks, which means low demand, low wage growth, and higher chances of a recession. Today, the low interest rate seems to have become a new normal or the only tool to save the economy in a post-COVID world. The US Federal Reserve has already gone on record to say that the low interest rate will continue for next few years as it is shifting to average inflation target to fix the interest rate in future. Is India also stepping into this trap of low interest rate to save the economy? The answer lies in RBI's monetary policy conduct in the last 18 months. The RBI has kept the system in surplus liquidity and also reduced the interest rate to record levels. In October policy, the RBI has clearly stated that it will continue with the accommodative stance as long as necessary, and at least during the current financial year and into the next financial year to revive the growth. And this, of course, by keeping the inflation low. But there are also dangers of keeping the interest rate low for a prolonged period to address low growth. Extremely low interest rate can create imbalances in the debt level of households, income of savers, depositors and pensioners, banks and lending institutions' profitability, and asset prices in stock market and real estate sector. For almost a year now, the real interest rates have been negative for savers and depositors. If we take the average bank deposit rate of 4.75% for a year with average CPI or retail inflation at over 6%, the interest rate are in negative zone or at minus 1.25%. The broad thumb rule for ideal rate in an economy is the positive real interest rates. The persistent low interest rate can have implication on the consumption, especially by retired people or the savers who invest only in fixed income securities. A prolonged period of low interest rate also leads to search for higher yields or returns. The savers tend to move to risky company deposit for higher returns or take bets in the stock market. The global capital inflows in large amounts push the asset prices in stock market, real estate and credit to risky segment. Large inflows also create a problem for the central bank as they have to absorb the low yielding dollars in exchange of high yielding domestic rupees. Ultimately, these are hot inflows and any sudden outflow would mean a crash in the stock market and also currency depreciation. The policymaker and regulators have to avoid any overheating in asset classes in a low interest rate regime. The East Asian crisis in 1997 is a good reminder when the currencies of some of the emerging economies had depreciated by over 50%. The low interest rate also encourages households to go for cheaper debt. India's household debt to GDP currently stands at around 11%, which is quite low as compared to developed countries like the US. But the debt levels are also rising very fast as it was in the range of 8 to 9% of the GDP 6 years ago. Given low GDP and a likely higher debt intake fueled by low interest rate in the near future, the debt to GDP will move much higher. The low interest rate also impacts the profitability of banks because of reduced NIMs or the net interest margin. This is because banks face a challenge in reducing deposit rate as it results in flight of deposit to other fixed income securities. A higher deposit rate and lower lending rate reduces the net interest margin. This kind of a higher deposit and lower lending rate scenario also encourages banks to go for high yield, high risk segments like MSMEs, unsecured lending and also lending to new untested segments. The banking regulator have to be very careful if there is a build-up in certain segments. In the last 5 years, the unsecured loan, especially the personal loan and credit card, saw the exposure growing to 10 to 15% of the balance sheet in some large private sector banks. So far, the RBI has made much deeper cuts in interest rate than expected in the last 18 months. This is likely to continue for some more time as the economy is going to contract in the current fiscal. There are already talks of ditching the inflation targeting or reducing the high food component in the CPI basket or creating a new benchmark for setting rates. The objective of all seems to be setting the stage for low interest rates. The low interest rate should not become a new normal or the only tool to save the financial system and the low economic growth. What we need today is a debate to address the growth issues by having more productive fiscal policies with a tight control over fiscal deficit, effective monetary policy transmission by banks to end borrowers, using the capital expenditure in right kind of revenue generating assets, infrastructure investment in airports, ports, roads and highways to push the exports and also attract foreign capital, and investing in real estate and construction to generate employment.